This is Matthew Cratter from Trader University, and today I'd like to answer the question, will the stock market bubble burst? This is a question I've been getting a lot in the comments and in my emails, and a lot of people are referring to this 2021 article by Jeremy Grantham, famous investor and one of the founders of GMO. A lot of people who don't know about him, he is a longtime value investor. He was very successful in the early 2000s. He rightly predicted that there was a bubble in the late 1990s, the tech bubble, the blue chip bubble. And he got out of the stock market, got his clients out of the stock market a little bit early. It was like 97 or 98. He lost a lot of business as a result. A lot of people pulled their accounts from him. He's obviously an institutional investor. And then he was proven spectacularly correct when the internet bubble popped from 2000 to 2002. He also did a nice job of predicting the housing market bubble and catching the bottom of the stock market in 2009. So he's an impressive guy. I believe he's a billionaire, very smart guy. That being said, I don't think he has the right take on the current situation. His take is that we are in the final stages of a major stock market bubble that is going to collapse. I would agree that we're in a major stock market bubble. I just don't think it's going to deflate in a similar way to what happened in 2000 and 2002 and 2007 to 2009 when we saw stock market declines in the S&P of something like 50%, maybe a little bit more than 50%. NASDAQ went down 80, 85%, something like that from 2000 to 2002. Now, Grantham does have a reputation a little bit as being a permabear. If you read his newsletters, as I've been doing for many years, he's almost always predicting a stock market collapse. So you have to take these articles with a grain of salt. That being said, here's a chart of the S&P 500 PE. We can see why a value investor might be upset with this. This is really, this was the 2000 peak. You can see that this is using 12-month trailing earnings, so there's a little bit of a lag. Earnings basically went to zero because went very close to zero or almost went negative in 2008, 2009. That's why we see this big spike in PEs. This was not because the stock market fell so much, even though it did, but because earnings collapsed. So there should be some normalization that's going on here. We can see that the PE peaked, the S&P 500 price to earnings ratio peaked in 2002 as earnings fell as well. That being said, this gives you a general idea. PEs are quite high for the S&P 500. They used to be higher in the late 90s. Coke was trading at a PE of 50 or so, to give you an example. So the major arguments that Grantham's making in his article is that we are in a late stage stock market bubble as measured by, he uses retail traders, retail investors, as one of his main indicators. I think this is a little bit misleading simply because retail investors have moved so heavily into indexing. That's where all the retirement funds go, etc. But I just want to sort of expound his argument here. Retail traders and investors, something happened in 2020 where all of a sudden a lot of them became bullish on the stock market. The stock market had been climbing this wall of worry, as they say, for the past 10 years. And for the most part, if you look at investor surveys, retail investors were pretty much on the sidelines and quite bearish, and that has finally switched. A lot of it has to do with the introduction of Robinhood, commission-free traders, the whole Dave Portnoy group, etc. A lot of day traders coming back, which is very reminiscent of the late 90s leading into the March 2000, September 2000 peak. There's also been a huge spike in retail purchases of call options. These were very popular in the late 90s, people buying call options on tech stocks. I was one of them who was doing this. I think this recent spike, I would attribute it quite a bit to just how the new fintech companies like Robinhood have made options trading so much more accessible and so much cheaper, basically free. In the old days, you used to have to spend $50, $100 for a round turn on call options, and now you can do it for free on Robinhood. So I would suggest that there is obviously a lot of speculative activity. A lot of this is also attributable to the fact that people were stuck at home, and many people still are stuck at home. They're getting some payments from the government, and they heard about Robinhood, and they had a lot of free time to day trade. So I think some of this can be explained by that. Obviously, the wild moves in Hertz, Kodak, Nikola, even Tesla. Tesla hasn't crashed back down. A lot of these have. So this can be a sign. Penny stocks that go up 20x and then collapse. This is obviously, a lot of this is driven by Robinhood and small retail traders. You can actually look at this call option trading, and you can look at people who are trading less than 10 call options. That would be the sort of the small time trader versus the large institutions, which trade thousands of call options. So there are ways of breaking this out, and I'm not going to go into it here. But there is a lot of retail activity in call options. In addition, we're at that point in the cycle where we're seeing just a lot of IPOs. There weren't that many IPOs in the 2010s. There were some big ones like Alibaba and Facebook, obviously, but not quite as many. We've had just a flurry of them in 2020 and now continuing into 2021. Traditionally, the cynical way of looking at IPOs is that it's a distribution from the smart money to the quote-unquote dumb money, where you have VCs and insiders, founders, selling their shares on the public market. Usually, companies will try to go public at times when things are fairly frothy so they can get a good valuation. And you have this transfer of money from dumb retail traders, quote-unquote dumb retail traders, to quote-unquote smart inside money. And we are at that peak where we've actually seen more IPOs. I think there were more IPOs in 2020 than there were in 2000. So all of these things do line up and suggest a lot of speculative frenzy. Obviously, the gigantic move up in Tesla, a lot of which is justified by just what a great company it is. It may have gotten a little bit ahead of itself. As you guys know, I sold my Tesla and moved into Bitcoin from one crazy investment to another crazy investment, neither of which I think are actually crazy. Let's compare what was happening in 2000, the peak of the 2000 and the 2007 bubbles, to the peaks in the recent peak. This is the famous Warren Buffett indicator, where he looks at the total stock market capitalization of the U.S. and compares it to GDP. The previous peak happened at somewhere around 146% of GDP. So you add up the whole stock market capitalization of the U.S. and it was 147% of U.S. GDP. This is significant. You can think of U.S. GDP as something like revenues. And so this is a way of sort of valuing the stock market based on the revenues of the entire economy. It's obviously more complicated than that, especially as government spending becomes a huge percentage of GDP. But what happened that was significant is that we have recently traded above. The stock market has become more expensive now relative to GDP than it was in 2000. Currently at 153. Well, it looks like this is actually a little bit outdated. It's higher than this now, but definitely above where it was in 2000. One thing that was interesting and strange, which Grantham speaks about in his article, is that the bubbles in 2000 and 2007 happened in the context of a very strong economy. A lot of the strength of the economy was financially driven. So the reason the economy was so strong in the late 90s is because stocks were so strong and people were making a lot of money in stocks, and so consumer spending was high, etc. A similar thing happened in 2007, where there was kind of a bubble in financial stocks. If you watch The Big Short, all these banks and mortgage companies levered off the housing bubble. But there was real strength in consumer spending as long as that housing bubble lasted, because people were making a lot of money with their housing speculation, and then they were able to spend that into the real economy. And so those were both sort of Goldilocks bubbles, not too hot, not too cold, as Greenspan was famous for saying about the economy in the late 90s. The 2000 stock market bubble was tech stocks and blue chips, as we talked about, Coke, General Electric. 2007 stock market bubble was really levered off of housing, and it never got quite as bubbly as in 2000. There were still a lot of people in 2007 who had gotten burned in 2000 and were instead speculating with housing instead of stocks. And then, of course, they ended up getting hurt really badly by the housing market collapsing. What's strange is we have this current stock market bubble and the economy is struggling. It's struggling to emerge from COVID. Something like, I think Yelp said that 25% of restaurants have gone out of business. Obviously, the travel industry has been decimated, airlines, etc. So there is there is this real effect. But the strange thing is that interest rates are very low right now. In fact, they're still at the bottom. In 2000 and 2007, the stock market bubble popped as the Fed tightened interest rates. If you're finding this video helpful, I'd encourage you to hit that subscribe and hit that like button. So if we take a look at where short-term interest rates were as measured by Fed funds, this is the rate that's set by the Federal Reserve, the central bank in the U.S. Back in 2000, Greenspan, who was the Federal Reserve chair back then, had been hiking really since March of 1999. He hiked until September of 2000. That's basically when the stock market peaked. That's when the S&P 500 peaked. The NASDAQ peaked a couple months earlier in March 2000. And he basically tightened until he popped the stock market bubble. Whether he did this intentionally or unintentionally, he brought rates up high enough where they could not, the stock market bubble, there's basically competition for capital. If you could earn 6% on a T-bill or on a treasury note, there was no reason to be in the stock market. So the stock market popped, the bubble popped as rates were tightened. Something similar happened as Greenspan and then Bernanke tightened from early 2004 through the peak in 2007. So those were both stock market bubbles that popped as interest rates got back, were tightened. And they got up to 6%. You could get a 6% yield in your savings account back in 2000. And you got almost that high in 2007. Fed funds got up to 5.25, and you could still earn, call it 6% on a T-bill. Something very different has happened this time, and I'm not sure, I don't think Grantham spends enough time thinking about the macro. What's very different here is we did get a tightening into 2019, and then obviously with the COVID crisis and also the repo crisis in the third and fourth quarter of 2019, the Fed was forced to cut rates and also start buying treasuries, what's called quantitative easing, where the Fed prints money and buys things. There was no quantitative easing back, or basically very little, back in the late 90s. This really started during the great financial crisis. So the previous stock market bubbles happened when interest rates, short-term interest rates were 5 or 6%. The 10-year note was at, the yield curve, I guess, was fairly flat. So the 10-year note was about 6% in 2000, and it got up to about 4.5% at the peak. Very different right now. We're at the lows. We have had an uptick in the 10-year treasury rates, which I'm going to talk about. What's really happened, though, in those late 90s, in Bill Clinton's second term, there was such a stock market bubble, and government spending was still fairly low. In spite of being a Democrat, Clinton really did cut a lot of government spending. He was also helped by huge tax receipts from capital gains from the stock market doing so well. And so in the late 90s, in 2000, the U.S. government, for one of the few times in its history, was actually running at a surplus. It was bringing in more money than it was spending. It's never happened again. And as a result, the U.S. government, in order to meet its spending goals, has had to issue a lot of debt. This is U.S. federal debt, and it's really skyrocketed from about 5.7 trillion in the late 90s all the way up to 26 trillion. Even if you measure it, if you normalize it for GDP, back in 2000, total federal debt as a percentage of GDP, so as a percentage of the basic size of the economy, you use GDP because it's a way of measuring, way of normalizing things and measuring what sort of debt an economy can support. In 2000, in late 2000, we were at about 55% total debt divided by GDP, and now we're well over 100%. We're on our way to 130, 140%. So the economy is much more levered. The federal government is much more levered. The banking system is not as levered up as it was in 2007, but all of that leverage has basically been transferred to the balance sheet of the U.S. government. We're also demographically in a very different place. Back in 2000, the baby boomers were really at the peak of their earning cycle, and now we're moving to the point where many of them are moving into retirement. And we have the millennials, who are the other big generation, really picking up the slack. The problem is we have all of this entitlement spending that's been mandated: Medicare, Medicaid, Social Security. We also spend quite a bit on defense and preparation for war, as well as interest on the debt. You can see these down here. These are the largest budget items, and you can't really cut any of them. You can't stop paying interest on your debt. You can't let the U.S. default on its debt. That would just destroy things. We fight a lot of stupid wars in a lot of countries, but that being said, if you're the world's superpower, if you have the world reserve currency, you probably still need to spend a lot on bombs and boats and airplanes. And then you obviously can't cut Social Security to people who've paid in the system, who may be depending on these payments to make their rent payments or mortgage payments or nursing home payments or food, etc. And so we're at this point where the U.S. government's bringing in $3.4 trillion in tax revenue, and the actual U.S. federal spending is about $7.8 trillion. And so there's a deficit. The U.S. government spending more than it's bringing in. There's a $4 trillion deficit. If you think back where the debt was in 2000, our government deficits are at about $4 trillion. Back then, the total debt was $5 or $6 trillion. So the entire macro environment has changed, and that's why what Grantham does, he's a little bit comparing apples and oranges. And again, he's more of a value investor. I think he's less good at looking at the macro, though he's certainly aware of it. We had this quote from Ilarion talking about how we basically have a rational bubble in the stock market, and I think this is right. What we have now is we have very, very low interest rates, basically at zero. We have a lot of money printing. We have the U.S. government. We have the Federal Reserve buying treasuries, buying junk bonds, buying mortgage bonds, and putting them on their balance sheet. This doesn't even go back far enough, but in 2000, the Fed's balance sheet was certainly below $700 billion, and now we're hitting new highs up here at we're basically 10x higher. The Fed's balance sheet is 10x, contains 10x the number of assets. So they basically print money, buy things, and stick it on their balance sheet. And this is how the Fed is monetizing U.S. deficit spending and allowing the U.S. government to spend more than it brings in. I talked about this a couple months ago. This is an old article from May of 2019 in which Warren Buffett talks about that if you think that 3% on the 30-year bond, a 3% interest rate on the 30-year bond, 30-year treasury, which is the government bond, makes sense. And if you think it's going to stay down there, then stocks are extremely cheap. If we take a look at where 30-year rates have gone since then, that was back in 2019, and rates now are sub 2%. As such, the stock market, even by Warren Buffett's own take, is undervalued if you're looking at it for the long term and comparing it. Basically, you can compare the dividend yield on the S&P and or the earnings yield to the Treasury note. Obviously, one of these is risk-free, quote-unquote risk-free. One isn't. But it's an interesting way of comparing two different asset classes and seeing which one is mispriced. So what I would suggest is that in this current environment, what we have is a stock market bubble that's not driven by animal spirits as it was in 2000 with tech stocks or in 2007 with housing, but this is something that's being fundamentally driven by adjusting the discount rate, by keeping interest rates so low. We have to keep interest rates low because we have a very big debtor called the U.S. government that cannot handle having higher interest rates. Consumers also have a lot of leverage, a lot of people with a lot of debt, especially coming out of COVID, and higher interest rates will just crush the economy. So we basically have a choice here, which is that you can cut government spending, you can let interest rates rise a lot and adjust for all the debt that's being issued, rather than having the Fed buying these treasuries and keeping interest rates low in that way. But if you do this, if you do some sort of austerity where you cut government spending, you cut payments to retired people, something like this, stocks and housing prices will fall a lot, especially if interest rates back up. If interest rates will move up if the Fed stops buying, and this will cut off the economic recovery, even though what we've had is a very tiny economic recovery. Asset prices will fall. This will hurt tax receipts. And so the only other choice is to destroy the currency, to let the US dollar continue to fall, not only against other fiat currencies like the euro and yen, but also against real assets like stocks, like houses. When the US dollar loses purchasing power, when the Fed prints a lot of it and increases the money supply, this drives down the purchasing power of the dollar and makes asset prices, assets that are denominated in dollars, go up in price. The Fed can never stop buying US treasuries. The US government can never stop spending. And so what we're witnessing the end of the current global financial system, which is based on the US dollar. We have the rise of Russia. Russia has stopped accumulating dollars and has moved into gold. It's trying to deal directly in yuan renminbi with China. And we have China that's trying to get its whole block of countries, various economic alliances, trying to get everyone to use the yuan and so that they don't have to touch dollars. China would very much like to be able to print its own currency and buy oil in the same way that the U.S. does this. So what I would suggest is it's not that stock and asset prices are going up because there's a bubble. It's just that currencies are going down. When the U.S. dollar loses value, stocks go up, gold goes up, housing prices go up, and Bitcoin prices go up. Bitcoin is the one non-manipulated market. It's not being manipulated by Tether or anything. It's basically a thermostat or a radon detector in the room that's telling you that the poisonous gas is increasing or that the temperature is going up. The Fed can manipulate interest rates. It cannot manipulate Bitcoin. And what Bitcoin is telling you is that fiat currencies are losing their value. Bitcoin is going up in every single currency. It's going up in euros. It's going up in yen terms. It's going up in dollar terms. So when Jeremy Grantham says there's a stock market bubble, I think he's missing this macro backdrop. And the real elephant in the room is the central bank. They're not going to raise rates this time. They cannot afford to raise rates. They'll completely destroy the economy, destroy asset prices. As such, I do believe there's a stock market bubble. There's also a treasury market bubble. There's a junk bond market bubble. There's a housing market bubble. There's a Bitcoin bubble. But these are all rational bubbles. They are based on the fact that the US dollar is going the way of the dodo. There's going to be a transition to a new global financial system over the next 5, 10, 15, 20 years. And it's hard to know exactly what that new reserve currency is going to be. A lot of it could be stored in Bitcoin in the terms of Bitcoin becoming a new central bank reserve asset. There'll probably also be some floating basket of currencies that might be the new global reserve currency. So maybe it's a basket of euros and renminbi, yuan, and dollars, something like that. So this is the transition we're seeing. It's very different from 2000 when you had baby boomers at the peak of their earning. They had a lot of disposable income. They could day trade stocks. They could play around with the stock market. You had the rise of early low commission brokerages, discount brokerages back then, etc. It's very different now. We're at the end of the Bretton Woods system that was set up after World War II. U.S. went off the gold standard in 1971, and there's been a slow collapse in the U.S. dollar since then. At some point, people will get tired of holding U.S. dollars. They're already tired of holding U.S. dollars. Chinese investors are trying to diversify out of dollars, as is their central bank. We already talked about how the Russian central bank has stopped buying dollars and is buying gold instead. In the last couple of days, we've seen the Dixie, which is the U.S. dollar index against other fiat currencies like euros and yens. It's been ticking higher. At the same time, we saw Treasury notes, the 10-year Treasury note, move higher from about 1% to about, it got as high as 1.1, almost got to 1.2%, now at 1.1%. This is basically what the Treasury market does when the Fed is talking about tapering. They're saying they're not going to buy as many treasuries, and Then you have Biden on the other side and the new administration saying we're going to spend a gazillion dollars, trillions and trillions of dollars. And what this means is that there's a huge supply of treasuries coming and the market's beginning to price in higher yields. At some point, the Fed has to step in and cap those yields, put a lid on them. This is what's called yield curve control, YCC. And when they control the yield curve, when they control long-term rates on the 10-year note, this has a direct flow through into housing prices. If you can get a cheaper mortgage, it means you can pay more for a house. When they control the Fed funds rate, the short-term rates and the long-term rates, they can basically keep asset prices high. The U.S. economy is in no position to endure a 40, 50, 60% drawdown. We had a brief drawdown in March of 2020, and we saw what the Fed did. They stepped in very quickly. I think we only sold off 25 or 30% in that case. We had those really big declines in 2000, 2008, and 2009. That cannot happen again. The Fed cannot allow interest rates to move higher. It cannot allow asset prices to fall that much and further crush tax receipts and lead to even more deficit spending. And so I think it's a fairly stark choice, but the choice is basically trash the economy or trash the US dollar. A lot of people don't pay attention to the US dollar, how they're losing purchasing power. If you get a 5% raise every year, but the purchasing power of the US dollar falls 10 to 15% every year, you are losing out on real terms. But a lot of people don't think in these terms. It's very easy to hide it. Whereas if housing prices collapse or stocks collapse, this hurts everyone. And it also leads to job loss and job losses and a contraction in the economy. So that being said, we could see the US dollar tick higher at some point when it really begins to affect stocks. The Fed will step in. I think the Fed, they've already begun to talk back. So 6 days ago, they were talking about they were going to taper, which means to reduce their balance sheet. And then the stock market sold off and they immediately had to talk back, push back on the bond taper. As a result, interest rates then have moved back down a little bit. So to answer the question, I think Grantham is wrong here. I don't think we're going to see a spectacular collapse of 50 or 60% in the S&P 500 or the NASDAQ. We could certainly see a 10, 20% sort of mini bear market, but I don't think this is one of those speculative bubbles that has a spectacular collapse as the 2000 bubble did. It's very different. This is all underpinned by central banks, especially the Federal Reserve, trying to hold together the existing financial system. They're eventually going to fail, but in the process, as they fail, you could have asset prices go up a lot. A lot of people don't realize that the stock markets in Zimbabwe and Venezuela, for example, as the fiat price of their currency collapsed, they had the Zimbabwe stock market goes up hundreds or thousands of percent every year. It doesn't do anyone any good who's holding Zimbabwe dollars because the dollars go down even more in purchasing value. But I think we're seeing kind of a first world version of that, where a stronger dollar hurts everyone, including the U.S. A weaker dollar is good for everyone, including the U.S. and including all asset prices. And this is what I think that Jeremy Grantham gets wrong. If you have the government printing up new money, starting UBI, Universal Basic Income, sending people money so they can stay at home and put the money in their Robinhood accounts and buy Tesla or speculate in penny stocks, this leads to a lot of speculative activities. But paradoxically, it's happening not because the economy is good, but because the economy is really bad. And as a result, the Fed can never stop printing. The government can never stop its transfer payments to its citizens. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.